financial advisory, investment and funds management services are just some of the many services provided by Macquarie Group. Founded in 1969, Macquarie now employs 15,849 people globally, working in a diverse range of work areas, developing and growing the bank, competing with competitors. COVID-19 saw a substantial number of businesses fall at the hands of the pandemic, struggling to make quarterly targets and see a slow depreciation in the overall value within the company. Although Macquarie faced challenges in this pandemic, they are able to adapt and continue their growth through their range of business and strong capitalisation. Macquarie has taken on a traditional approach in implementing effective risk management, which has contributed to great achievements that the bank has had in recent times. I, Daniel Callaghan from the Griffith University, issue a whole recommendation from Macquarie Bank. Macquarie Group have proven their worth by exceeding expectations from analysis and implementing achievable strategies for effective growth. However, I feel as though there is more yet to come from the bank. Analytics predicted the price to be $155 in December 2021. This price has already been passed as of May 2021, sitting at $161. From May as well, we can observe the 52-week range from 97 to 162. It is evident of the bank's ability to increase revenue and improve the overall price of the company through key strategies implemented within the bank. The diversity in the group allows them to build on the foundation of the structure and services offered by Macquarie, giving the bank continuous opportunity to grow and develop. Macquarie has a long-standing policy of keeping hold of expected level of capital that will support its business while allowing the growth of consistent capital for business requirements. In September 2019, we saw Macquarie issue $1.7 billion of equity capital. This is done through a $0.7 billion share purchase plan and a $1 billion institutional placement. This plan allowed Macquarie additional capital to provide important flexibility at this time. Through this, the bank is able to invest new ideas into upcoming opportunities and still maintain the correct capital levels in case of any unforeseen market changes. Increased dividend payouts is a key sign of company profits. For FY21 and 23, we saw an increased payout ratio of 69%, proving the point of continual efforts that Macquarie show in pursuit of growth opportunities to target the constant growth and evolution of the banking industry. This is done through the diversity of work areas that Macquarie apply their services to. Having such a diverse range of business, the company's opportunities have no limits to new ideas and strategies that the Macquarie can implement due to the bank not being fixed to one specific area, markets, or regions in which they dictate how they conduct their work. This diversity comes at a great advantage as Macquarie are able to maintain operational flexibility and can adapt the portfolio mix to the changing market conditions. The risk management structure that Macquarie have put into place has been designed to ensure that it is able to meet its funding requirements due to any unexpected downfall due to a range of unforeseen market conditions. Their funding structure is stable, ensuring minimal dependence on short-term wholesale funding markets to make up for any downfall. For example, in March 2020, Macquarie's term assets were covered by term funding maturing beyond 1 year. The weighted average term to maturity was 4.8 years. We also saw Macquarie committed to a $3.4 billion of capital into a principal finance debt book in the last 9 months. This long-term growth strategy as a company plans to implement capital investment to fund future growth. Overall, the key point being made here is that Macquarie are implementing an effective risk management strategy which funds present and future growth, creating greater stability and providing an alternative funding source for borrowers. This also creates flexibility for the bank allowing them to fund other capital needs and reduces dependence on one capital source. Furthermore, Macquarie's success globally is quite unique in the fact that all investments are explored. Asia had an income of $1.5 million for the year ending 31st March 2020 from $1.1 million in the prior year. This was a 38% increase. This increase was driven by asset realizations within the green energy sector. CGM has also had improved equity performances due to an increased contribution of client activity. To add on to the global success, Macquarie has future plans to expand into the US. Last year, the bank had bought all the shares in Waddell & Reed Financial, which is listed on the New York Stock Exchange. The US firm manages $176.8 billion in assets for individuals and businesses. This acquisition is an incredible strategic move which will see Macquarie's expected growth increase and provide long runs of profit. This transaction will result in Macquarie becoming the top 20 actively managed US fund managers. From this acquisition, Macquarie Asset Management is expected to increase to over $650 billion. This move by Macquarie shows that the bank is able to keep up with competitors and adjust with global standards. The ECL methodology and SICR thresholds have remained consistent with prior years. There have been steady, consistent profits over the last 8 years for Macquarie, and it is expected that the bank will have a growth rate of 8.5% per year. This has been backed by the cash flow by Macquarie for the year ending 2020. As mentioned before, an increased cash flow statement indicates the company's liquid assets are increasing. This is a positive outlook as it reflects money paid out to shareholders, expenses paid for, and future financial challenges covered securely. For this year, Macquarie removed client-related margin money and excess cash that was received from certain clients. From this, the bank had increases in margin money and settlement assets, cash, and bank balances. We also saw increased profits in both banking and financial services, and capital coming to a total of $14.5 million. We've seen the outstanding performance from Macquarie for the year ending 2020. However, there are also risks that need to be recognised when investing in bank stocks. Banks are sensitive to recession and always run the risk of global financial crisis. Relating to the most recent issue is the COVID-19 pandemic, where we saw banks generate significant instability and high volatility in the global capital markets. We also have to be cautious of how bank stocks can get affected by the interest rate fluctuations, meaning they rely on consumers to spend and borrow money for their own profits. Overall, I'm confident that Macquarie Group will be a good long-term investment due to their consistency in growth and diversity across working sectors. Their strategies implemented focus on long-term growth and capital opportunities rather than short-term goals, which is a positive outlook. The most common risks that banks face, Macquarie have been able to counteract these challenges and implement effective growth. Development in the US is a move where the overall global growth of the bank will take to new levels. Macquarie's corporate governance is backed by well-trained and experienced staff who have already demonstrated good profits and business decisions for Macquarie Group.